And that right there is why Wall Street is about to get embarrassed by these 4 stocks in 2026. Wait. Don't blink, because if you own any of these, this might get uncomfortable. What's poppin', everybody? Welcome back to Millionaire Microcaps, where we hunt for setups before Wall Street wakes up. Grab your caffeine. Grab your emotional support portfolio, because today's video is one of those videos. You know, the kind you watch back in 6 months and go, wait, how did I not take this seriously? I'm breaking down 4 stocks, only 4. Because when you give people too many names, they remember none of them. These are ignored stocks, beaten down stocks, stocks institutions still aren't positioned for, but heading into 2026. These setups could get real uncomfortable, fast. Everywhere you look right now, it's the same noise. AI bubble, market crash, sell everything and live in cash forever. Cool. Now let's look at what the market is actually doing. The Nasdaq topped out. Big tech started wobbling. Everyone panicked, and then something interesting happened. Money didn't leave the market, it moved. Small caps started running. Last month alone, S&P barely moved, Nasdaq basically took a nap. Small caps ran close to 7%. That doesn't happen in crash environments. Small caps get smoked in crashes. They only lead when rates start coming down, liquidity improves, risk appetite comes back. That's the environment forming right now. All right, let's get into the names. Let's start with the stock everyone loves to clown on, SMCI. This thing is trading like it committed a felony. But here's the part that matters. The business didn't break. The narrative did. No servers equals no AI. That's not an opinion. That's physics. Nvidia sells the chips. AMD sells the chips. But guess what? Those chips don't float in the air. SMCI builds the actual servers, power, cooling, customization, shipping. Yes, there was accounting drama. Yes, FinTwit lost its mind. But here's what actually happened. New auditor hired, 10K filed, Nasdaq compliance intact, the existential risk crowd. Wrong. Now look at valuation. Forward price to sales under 1. Peg around 0.5. That's not fair value. That's emotional selling. If AI spending slows a little, SMCI still grows. If AI spending keeps accelerating, this thing doesn't politely go up. It snaps. Before the next stock, quick pause. The next company on this list is one people laugh at right now. But if it works, it changes how an entire industry operates. Stick with me. All right, deep breath, because this is where people start getting emotional. HIMS. This stock makes people mad, and that's exactly why it's interesting. Bears say, low moat, too much competition, just pills and vibes. Cool, now let's talk reality. HIMS is healthcare as a subscription.
Number 3. It is a seamless experience at Hims & Hers across. You get the telehealth visit, you get the prescription, and then you get fulfillment of the prescription by an online pharmacy, and it's mailed to you. So there's
And that's why legacy healthcare hates it. Doctors don't love it. Insurers don't love it. Pharmacies don't love it. Why? Because HIMS cuts them out. Now look at the numbers people conveniently ignore. Revenue up nearly 50%. Subscribers still growing. ARPU climbing. That means customers aren't just trying it, they're staying. Then management did something that completely broke the bearish narrative. They authorized a $250 million buyback. Growth companies burning cash don't do that. Companies with confidence do. Now here's where it gets spicy. This isn't really a healthcare company. It's a consumer brand with medical rails. Wall Street has no idea how to price that. If this were valued like software, it's cheap. If it were valued like a consumer subscription, it's cheap. The only reason it still looks controversial. People don't like the idea of healthcare changing. That emotional bias, that's alpha. Before we talk about Adobe, let me say this. The next stock is the exact opposite of HIMS. No hype, no drama, no viral headlines. And that's why it quietly destroys portfolios in a good way. Most people won't buy it because it's boring. Those people usually regret it. All right, let's talk Adobe. Adobe, the stock nobody brags about at parties. People thought AI would kill it. Instead, AI made it stronger. Here's why. Professionals don't chase tools. They live inside workflows. Adobe owns the workflows. Firefly isn't a toy. It's baked directly into Photoshop, Premiere, Illustrator. Same customers, higher productivity, higher pricing power. And Adobe didn't need to spend billions chasing users. They already had them. That's operating leverage in its purest form. 89% gross margins. Free cash flow fortress. Valuation sitting near decade lows.
End of this year at $23.77 billion of revenue. They reached a new all-time high in total performance obligations, so this is almost like guaranteed revenue.
This is the
22
kind of stock people ignore until it quietly doubles while everyone pretends they always liked it. This one is my favorite, and yes, I saved it for last on purpose. UiPath automates the boring stuff companies hate paying humans to do. Invoices, compliance, HR, not sexy, extremely powerful. When rates were high, budgets froze. Automation got delayed. The stock got wrecked, but the business still intact. Now rates are coming down, and CFOs don't buy hype. They buy cost cutters. UiPath has 10,000 plus enterprise customers, deeply embedded workflows, massive switching costs, $1.4 billion net cash peg under one. Once companies build automations on UiPath, they're not ripping them out. This stock didn't break. The macro did, and the macro is flipping. 2026 isn't about chasing headlines. It's about positioning early. SMCI, HIMSS, Adobe, UiPath, ignored, mispriced. Potentially dangerous. Drop your favorite below. Smash like so the algo doesn't bury this. Subscribe if you want setups before Wall Street wakes up. Stay sharp, stay patient, and stay dangerous.